What if I told you that millions of Canadian seniors could lose financial security in 2026 without a single eviction notice or warning letter? Sounds impossible, yet new laws and policy changes are quietly reshaping taxes, pensions, healthcare, and housing. Seniors on fixed incomes are discovering that small rule changes can erase savings, raise costs overnight, and force decisions. The question isn't whether change is coming, but whether you are prepared. Here's the unsettling reality. Governments are updating property tax formulas, benefit eligibility rules, and healthcare funding while inflation remains high. Research shows seniors are vulnerable to sudden cost shocks when income is fixed and expenses rise together. When policies shift quietly, the impact feels sudden. So which laws matter most, and who is at risk first? Stay with me to uncover 10 Canadian laws that could change retirement in 2026 and learn how to protect yourself before it's late. Number 1. Property tax shock. Across Canada, property taxes are no longer rising slowly. They are jumping sharply as municipalities reassess home values based on recent market data. For seniors who bought their homes decades ago, this creates a dangerous mismatch. Home values may look high on paper, but income has not kept pace. Many seniors are asset-rich but cash-poor, meaning higher tax bills arrive without the income to cover them. In 2026, updated assessment formulas and municipal funding gaps are pushing property taxes higher than inflation in many regions. What makes this especially alarming is how these changes interact with fixed retirement income. CPP and OAS increases often lag behind real housing costs, while private pensions may not adjust at all. Research on aging population shows that sudden increases in non-discretionary expenses, like housing taxes, force seniors to cut essentials such as food, heating, or medication. Some provinces offer deferral programs, but these often act like hidden loans, accumulating interest and reducing the value of the home over time. For many seniors, the final consequence is heartbreaking. Rising property taxes can push people to sell homes they plan to live in for life. Downsizing is not always cheaper, and rental markets are tight. What was once a symbol of security becomes a financial trap. In 2026, property tax changes may not look like confiscation, but for seniors living month to month, they can feel like losing everything, slowly, legally, and with very little warning. If rising costs worry you, tell us in the comments how this affects your home. Please subscribe to support our work. It's just one click, and it helps us keep producing deeply researched videos like this. Number 2. Capital gains trap. Many Canadian seniors plan to sell their home one day, to downsize, move closer to family, or pay for care. What few realize is how capital gains rules can quietly erase a large portion of that nest egg. While a primary residence is usually exempt, changes in use, such as renting out part of the home, moving temporarily, or owning multiple properties, can trigger taxable gains. In 2026, tighter reporting rules and automated audits are making these cases far more common. What has changed is enforcement and interpretation. The Canada Revenue Agency now relies heavily on data matching, meaning past decisions that went unnoticed are being reassessed years later. Seniors who rented a basement to survive inflation, moved in with family for medical reasons, or delayed selling after relocating may suddenly face unexpected tax bills. Studies on retirement finance show that unplanned tax shocks are among the fastest ways seniors lose long-term financial stability, especially when savings are limited and income is fixed. For many retirees, this becomes a devastating surprise. A home sale meant to fund retirement or long-term care ends up shrinking dramatically after taxes, legal fees, and penalties. Some seniors are forced to borrow, delay care, or sell additional assets just to settle with the CRA. In 2026, capital gains rules don't look dramatic, but their impact can be severe. Without careful planning, what was meant to protect independence can instead accelerate financial loss, leaving seniors far more vulnerable than they ever expected. If you're planning to sell or downsize, share your concern in the comments. Your experience could help others. Please subscribe to support our work. It's just one click, and it allows us to keep breaking down complex laws that matter. Number 3. Long-term care cost shift. Over the last few years, Canada has quietly changed how long-term care is funded, And in 2026, the impact is hitting seniors harder than ever. While basic care may still be publicly supported, more services are being reclassified as optional or supplemental. This includes private rooms, enhanced supervision, mobility assistance, and certain medical supports. Research on aging populations shows that as care needs increase, out-of-pocket expenses rise sharply, often faster than pensions or savings can keep up. What many seniors don't realize is how quickly these costs add up. Monthly fees for upgraded care can run into thousands of dollars, and wait lists for fully funded public facilities are long. Families are often forced to make decisions under pressure, choosing private options simply because there is no alternative. Studies in health economics show that unexpected long-term care expenses are one of the leading causes of seniors exhausting lifetime savings within just a few years. For retirees who believed health care would always be covered, this shift is devastating. Savings meant for comfort, travel, or inheritance are redirected toward basic care. In some cases, seniors are pushed to sell their homes to finance long-term care, losing both financial security and emotional stability. In 2026, this isn't about luxury, it's about access. As funding models change, long-term care is becoming one of the biggest threats to seniors' independence, quietly draining everything they work their lives to protect. If long-term care costs worry you or your family, leave a comment with your thoughts. These conversations matter. Please subscribe to support our work. It's just one click, and it helps us keep explaining what others don't. Number 4. Pension indexing gap. Despite regular headlines about pension increases, many Canadian seniors are discovering that their income is no longer keeping up with real-life costs. CPP and OAS are indexed to inflation, but the formulas rely on broad averages that don't reflect seniors' actual spending. Housing, utilities, insurance, property taxes, and healthcare often rise faster than the general inflation basket. In 2026, this indexing gap means pensions may technically increase, yet purchasing power still declines. What research on retirement economics shows is that seniors experience a different kind of inflation. They spend more on essentials and less on discretionary items, but pension adjustments don't account for that shift. When energy prices spike, municipal taxes rise, or healthcare costs creep upward, those increases hit retirees directly. Even a small monthly shortfall compounds over time, forcing difficult choices between medication, nutrition, or home maintenance. The system wasn't designed for prolonged high-cost pressure, and it's showing strain. For many retirees, the result feels like a slow erosion rather than a sudden loss. Savings are used to fill monthly gaps, then emergency funds disappear, and eventually assets must be sold. This is especially dangerous for seniors living longer than expected, as longevity risk combines with income erosion. In 2026, pension indexing isn't failing outright, it's simply insufficient for the world seniors now live in. Without supplemental income or careful planning, this gap can quietly drain financial security, leaving people vulnerable after decades of responsible saving. If your pension no longer covers what it used to, share one change you've noticed in the comments. Please subscribe to support our work. It's just one click, and it helps us keep making videos that truly matter. Number 5. Estate and inheritance law changes. Over the past few years, changes to estate administration rules, probate fees, and reporting requirements have quietly increased the cost and complexity of passing assets to family. In 2026, more estates are being pulled into lengthy probate processes, even modest ones. Fees are calculated as a percentage of estate value, not income, which means seniors who own a home but little cash can still trigger significant costs. Research in estate planning shows that rising administrative friction often erodes inheritances more than people expect. What many seniors don't realize is how outdated wills interact badly with newer rules. Changes in family structure, remarriages, blended families, or estranged relatives can create legal challenges that freeze estates for months or years. Digital assets, joint accounts, and beneficiary designations are also scrutinized more closely. When documentation is unclear, courts step in, legal fees pile up, and assets meant for loved ones are consumed by process. Studies on aging and wealth transfer consistently show that lack of timely updates is one of the biggest causes of estate loss. For retirees, the emotional cost can be just as heavy as the financial one. The fear of leaving loved ones with confusion, conflict, or date weighs heavily in later years. In some cases, seniors spend down assets intentionally to avoid probate exposure, reducing their own quality of life. In 2026, estate and inheritance changes don't look dramatic, but they are powerful. Without careful planning, what took a lifetime to build can shrink rapidly at the end, leaving families with far less than intended and seniors feeling they lost control of their legacy. If you've updated your will or delayed it, share what's holding you back in the comments. Please subscribe to support our work. It's just one click, and it helps us keep turning complex laws into clear guidance. Number 6. Healthcare coverage limits. In 2026, many Canadian seniors are discovering that universal healthcare does not mean everything is fully covered anymore. Provinces have adjusted what qualifies as insured services, quietly shifting more costs onto patients. Items like extended physiotherapy, vision care, hearing aids, mobility devices, and some prescription supports now come with stricter caps, co-pays, or eligibility rules. Health policy research shows that when coverage narrows, seniors on fixed incomes delay care, which often lead to worse outcomes and higher long-term costs. What makes this change especially difficult is how gradual it feels. Coverage isn't removed overnight. It's limited, capped, or reclassified. A few visits are covered, then payments stop. Seniors suddenly face monthly bills they never budgeted for. Studies in public health consistently show that out-of-pocket medical expenses are one of the fastest-growing financial pressures on older adults, particularly those managing chronic conditions. When healthcare costs rise alongside housing and food, something has to give. For retirees, the impact is deeply personal. Skipping physiotherapy can mean losing mobility. Delaying vision care can increase fall risk. Avoiding hearing aids can lead to isolation and cognitive decline. These are not luxury services. They are essential to independence. In 2026, healthcare coverage limits don't look dramatic on paper, but in real life, they can slowly strip away quality of life and financial stability. Seniors who believed healthcare would always be there are now forced to choose between care and cost, a choice no one expected to face after a lifetime of contributions. If healthcare costs have surprised you, share one expense that caught you off guard in the comments. Please subscribe to support our work. It's just one click, and it helps us keep explaining what truly matters. Number 7. Home equity access rules. In recent years, Canada has seen a rapid rise in products that allow seniors to tap into their home equity, such as reverse mortgages and equity release loans. In 2026, new regulations and lending standards are changing how these tools work, often in ways that favor lenders more than homeowners. While these products are marketed as safe solutions for retirees needing cash, financial research shows they can quietly erode long-term security when rules tighten and fees increase. What many seniors don't see up front are the compounding effects. Interest accumulates quickly, property values fluctuate, and new disclosure rules mean loans can be reassessed under stricter conditions. If a homeowner fails to meet maintenance requirements, tax payments, or insurance conditions, lenders may demand repayment. Studies in retirement finance warn that poorly understood equity products are one of the fastest ways seniors lose control over their homes without ever selling them. For retirees relying on home equity to survive rising costs, these rule changes can be devastating. A home meant to be a final safety net becomes a financial pressure point. Families may be shocked to learn how little equity remains after fees and interest. In 2026, accessing home equity is no longer a simple decision. It is a complex legal and financial commitment. Without expert advice, seniors risk turning stability into vulnerability, slowly trading ownership for short-term relief until there is nothing left. If you've considered using home equity, share your biggest concern in the comments. Please subscribe to support our work. It's just one click, and it helps us keep creating deeply researched videos like this. Number 8. Digital-only government services. As Canada accelerates its push toward fully digital government systems in 2026, many essential senior services are quietly moving online only. Pension updates, tax filings, healthcare benefits, and even housing assistance applications are now increasingly handled through apps and web portals. While officials frame this as efficiency, studies on digital exclusion show that a large percentage of seniors struggle with complex interfaces, password systems, and two-factor authentication, leaving them locked out of services they legally qualify for. Meanwhile, seniors without reliable internet access or modern devices face a growing gap. Rural communities, low-income retirees, and those with declining vision or memory often find these platforms confusing and overwhelming. Research in gerontology highlights that forced digital transitions increase anxiety and reduce service uptake among older adults. When deadlines are missed due to technical issues, benefits can be delayed or even suspended, creating sudden financial instability that feels both unfair and frightening. Over time, this digital-only shift doesn't just inconvenience seniors, it slowly erodes their independence. Instead of walking into an office and speaking with a human being, they are redirected to chatbots, automated phone menus, or email forms that may never get answered. Experts warn this creates a silent form of exclusion, where seniors technically still have rights, but practically cannot access them. For many, the fear isn't technology itself, but the feeling of being forgotten in a system that no longer sees them. If this reality worries you, share your thoughts in the comments and tell us what seniors are facing where you live. Support our work by subscribing to the channel. It's just one click, and it truly helps us keep going. Number 9. Banking and digital ID rules. Across Canada, banks and government agencies are rapidly moving toward digital-first systems, and in 2026 this shift is hitting seniors the hardest. New rules around digital identification, online verification, and paperless banking are becoming the default, not the option. In-person services are being reduced, branches are closing, and many essential tasks now require apps, two-factor authentication, and online portals. Research on aging and technology shows that forced digital transitions significantly increase financial risk for seniors who are less comfortable with complex systems. What makes these rules especially dangerous is their connection to fraud prevention and compliance laws. Accounts can be temporarily frozen if digital verification fails, logins look unusual, or responses are delayed. Seniors who struggle with passwords, smartphones, or verification steps may suddenly lose access to their own money. Studies in consumer protection show that older adults are disproportionately affected by account lockouts, delayed benefit deposits, and identity verification errors, often with no immediate human support available. For many seniors, this creates a frightening loss of control. Bills go unpaid, benefits are delayed, and legitimate transactions are flagged as suspicious. In some cases, access is restored only after weeks of stress and paperwork. While these rules are designed to stop fraud, they also expose seniors to new vulnerabilities, especially those living alone or without tech-savvy family support. In 2026, banking and digital ID rules are not just an inconvenience, they are a financial risk. When access to money depends on technology you don't fully control, stability can disappear fast. If digital banking has made life harder for you, share your experience in the comments. Please subscribe to support our work. It's just one click, and it helps us keep raising issues that truly affect seniors. Number 10. Benefit eligibility tightening. In 2026, Canada has quietly tightened the rules around who qualifies for key senior benefits, including income-tested supports, housing supplements, and additional health assistance. While these programs still exist, eligibility thresholds have narrowed. Small increases in income from part-time work, investment interest, or even selling an asset can now trigger clawbacks or full loss of benefits. Research on social policy shows that seniors on the edge of eligibility are the most vulnerable, as they often lose support faster than their income actually rises. What makes this especially troubling is how complex the rules have become. Many seniors don't realize they've crossed a threshold until payments drop or stop entirely. Forms are harder to understand, reporting requirements are stricter, and mistakes are costly. Studies on aging and public benefits show that administrative complexity alone causes thousands of eligible seniors to lose support each year, not because they don't qualify, but because they can't navigate the system in time. For retirees living on thin margins, benefit tightening can be devastating. Losing a monthly supplement can mean falling behind on rent, skipping medication, or relying on family for survival. Once benefits are lost, reinstatement is slow and uncertain. In 2026, this final change ties everything together. Housing costs rise, healthcare costs increase, and support shrinks. Seniors are not losing everything overnight, but piece by piece. And when benefits disappear, independence often follows. If benefit rules have affected you, write one honest sentence in the comments. Your story matters. Please subscribe to support our work. It's just one click, and it helps us continue making videos that protect seniors through awareness. After examining all 10 laws and policy shifts together, a clear pattern emerges. Canadian seniors are not facing one single threat, but a system that is slowly becoming less forgiving, less supportive, and more expensive to navigate. Property taxes rise while income stays fixed. Healthcare coverage narrows just as medical needs grow. Benefit rules tighten at the exact moment seniors rely on the most. None of these changes arrive with alarms, yet their combined impact can dismantle decades of financial stability. What makes 2026 especially dangerous is timing. Many of these laws are activating or being enforced simultaneously, while inflation, housing pressure, and demographic strain continue to rise. Research consistently shows that seniors are most vulnerable to compound shocks, small losses stacking together until recovery becomes impossible. A higher tax here, a clawback there, a medical bill that wasn't covered, or a banking rule that locks access for weeks. Each change alone may seem manageable, but together they can push people past the edge. For seniors watching this, the message is not panic. It is awareness and preparation. These laws do not mean everything will be taken overnight, but they do mean that inaction is no longer safe. Updating documents, understanding benefit thresholds, planning healthcare costs, and asking questions early can make the difference between control and crisis. Seniors work their entire lives for stability and dignity. Losing that quietly, through complexity and delay, is the real danger. In 2026, knowledge is protection. The more you understand what is changing, the more power you keep. These laws may be passed, but how they affect your life still depends on what you do next. If this video spoke to you, leave a comment with one word that describes how you're feeling right now. Please watch our previous video for deeper insight, and support our work by subscribing. It's just one click, and it helps us keep making these videos with real effort and care.